Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Starbucks Corporation quarterly report. Starbucks Corporation provides a wide range of businesses and services through its various segments. At its core, the company operates as a roaster, marketer, and retailer of coffee internationally. Its stores offer a variety of products including coffee, tea, and other beverages, roasted whole beans and ground coffees, complimentary food, packaged coffees, single-serve products, and ready-to-drink beverages. In addition to its retail operations, the company also licenses its trademarks through licensed stores, grocery, and food service accounts. This allows Starbucks to expand its reach beyond its own physical locations. The company offers its products under several brands, including Starbucks Coffee, Teavana, Seattle's Best Coffee, Ethos, and Starbucks Reserve. Overall, Starbucks Corporation provides a range of businesses and services that cater to the needs of coffee lovers around the world. From retail stores to licensed accounts, the company has established itself as a leading player in the global coffee market. Starbucks Corp's stock price has experienced a significant drop over the past year, exceeding -10.38%. The decline can be attributed to several key factors. Weaker comparable store sales and missed earnings expectations have been major contributors to this downturn. In addition, increasing cost pressures have also weighed heavily on the company's performance. One of the most notable periods of decline was in mid-2025, when Starbucks shares fell 18.6% over 6 months. This period saw a significant contraction in operating margins and a substantial decrease in earnings per share. The company faced pressure in its core U.S. market, with comparable sales slipping 2% and transaction volumes decreasing by nearly 4%. The fiscal fourth quarter of 2025 also saw a decline in the stock price after Starbucks reported worse-than-expected earnings. Adjusted earnings per share missed analyst estimates, and GAAP earnings per share fell sharply to $0.12, an 85% decline from the previous year. Despite these declines, the stock showed strong momentum in early 2026, with shares up 14.5% by late January. However, the stock was still down for the past 12 months compared to its 12-month lows in the $70s. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the increase in other revenue category by 24.9% is a significant contributor. The acquisition of 23,500,000 Degrees Topco Limited and the joint venture with Boyu Capital in China have also led to an expansion of company-operated stores and increased revenue. In addition, royalty revenue, inventory purchases, intercompany borrowing and lending activities, dairy purchase contracts, forecasted dairy demand, coffee forward contracts, futures contracts, and collars have all contributed to revenue growth. The company's international markets, particularly China, are also showing growth, with the North America segment experiencing a 4% increase in global comparable store sales. On the decline side, labor investments in support of the Back to Starbucks strategy have contracted operating margin by 290 basis points. Inflationary pressures, largely driven by elevated coffee pricing and tariffs, have also led to revenue decline. The decrease due to lower product sales and royalty revenues from licensees in the North America segment is another factor contributing to revenue decline. Furthermore, restructuring-related costs, inflationary pressures, elevated coffee pricing and tariffs, labor investments, and reduction in retail renovations and new store investments in North America are all drivers of revenue decline. Overall, a combination of growth drivers and decline drivers has impacted the company's revenue, highlighting the importance of strategic planning and adaptation to changing market conditions. The company's net income and profit margins experienced a significant decline between Q4 2024 and Q4 2025. Net income decreased by $487.7 million, from $780.8 million to $293.3 million, indicating a substantial drop in profitability. This decline was accompanied by a decrease in both net revenue margin and operating income margin, falling from 10.6% to 9.4% and 11.9% to 9%, respectively. The reasons behind this change are multifaceted. The company's losses from derivatives recorded in accumulated other comprehensive income, AOCI, and reclassification of gains/losses from derivatives to revenue, product and distribution costs, or interest income and other, net, contributed to the decline. Additionally, changes in fair value of derivative instruments, foreign currency fluctuations, commodity price uncertainty, inflationary pressures, elevated coffee pricing and tariffs, labor investments, restructuring costs, and reduced capital expenditures all played a role. These factors collectively impacted the company's profitability, leading to a decrease in both net income and profit margins. The decline in profitability was likely due to a combination of external market conditions and internal business decisions, which together resulted in a significant reduction in the company's financial performance between Q4 2024 and Q4 2025. Based on the extracted summary, it is clear that the company is indeed generating positive operating cash flow. This is evident from two key pieces of information: a direct statement on page 43 confirming this trend, and a numerical value on page 4 showing a significant amount of net cash provided by operating activities. The fact that the company had $1,597.7 million in net cash provided by operating activities for December 28, 2025, is a strong indicator of its ability to generate positive cash flow from its core operations. This suggests that the company's business model is efficient and effective in generating revenue and managing costs. Overall, these findings suggest that the company is on solid financial ground, with a healthy operating cash flow that can be used to fund future growth initiatives or pay off debt. The company's debt level has remained relatively stable over the past few years, with minor fluctuations. According to the extracted summaries, long-term debt has decreased by $5.6 million from 2024 to 2025, but this decrease is not significant enough to indicate a substantial change in the company's debt level. Furthermore, the projected long-term debt for future years remains consistent, with no notable changes. In contrast, interest expenses have increased slightly due to changes in benchmark interest rates and hedging activities. The interest expense has risen by $11.8 million from 2024 to 2025, indicating a slight increase in the company's financial obligations. However, this increase is not substantial enough to suggest a significant change in the company's debt level or overall financial health. The company's performance varied across different segments and regions. On a positive note, the North America operating segment showed strong results, indicating a stable market presence in this region. Additionally, certain international markets also performed well, contributing to the company's overall growth. However, not all regions fared equally well. International markets, particularly China, struggled due to issues related to restructuring plans and joint ventures. These challenges hindered the company's expansion efforts in this key market, resulting in underwhelming performance. Management is optimistic about the company's outlook, particularly in China, where they aim to accelerate long-term growth through a joint venture with Boyu Capital. This expansion will enable the company to tap into new markets and increase its presence across the country. To drive top-line momentum, management has committed to refining and executing Back to Starbucks initiatives. These efforts focus on enhancing customer experience, investing in cafes, delivering seamless digital experiences, improving supply chain efficiency, and leveraging technology to boost sales leverage. In addition to these growth strategies, management is prioritizing disciplined capital allocation and strategic investments to ensure long-term sustainable business growth. The company also expects to reduce depreciation and amortization expenses, as well as store operating costs, following the transaction with Boyu Capital. Furthermore, management plans to utilize the proceeds from the transaction to reduce debt and strengthen the balance sheet. This will provide greater financial flexibility for executing the company's long-term growth strategy. Overall, management is confident in the company's ability to achieve its goals through a combination of strategic investments and disciplined financial management. Starbucks has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has formed a joint venture with Boyu Capital to operate its retail business in China. This partnership allows Starbucks to expand its presence in the Chinese market while also benefiting from local expertise. Additionally, Starbucks acquired 23.5 Degrees Topco Limited in the first quarter of fiscal 2025. This acquisition is expected to enhance the company's global supply chain capabilities and improve its overall efficiency. On the other hand, Starbucks has made some divestitures as part of its restructuring efforts. The company has closed several coffee houses, resulting in significant restructuring costs. Furthermore, it has classified its retail operations in China as held for sale, indicating a potential exit from this market. The company has a history of paying dividends to its shareholders. As per the provided information, the company has indeed distributed dividends in the past. Specifically, it is mentioned that a quarterly cash dividend of $0.62 per share was paid on February 27, 2026. In addition to this recent payment, the company's financial records show that it has also made significant payments related to dividends in previous years. Although the amounts are negative, indicating a payout rather than an income, they demonstrate the company's commitment to returning value to its shareholders through dividend distributions. The exact figures for these payouts can be found on page 4 of the document, where -$705.1 million and -$691.9 million are listed as payments made on December 28, 2025, and December 29, 2024, respectively. These amounts further emphasize the company's focus on dividend payments. Overall, it is clear that the company has a well-established practice of paying dividends to its shareholders, with recent payments being part of this ongoing commitment. Concerns about inventory buildup and supply chain disruption are valid based on recent data. Inventory levels have increased significantly, reaching $2,114.4 million, a rise from the previous year's figure of $2,185.6 million. This increase is attributed to higher costs of raw materials or ingredients, which has led to an additional expense of $168 million in product and distribution costs. Furthermore, supply chain disruptions are also a concern due to various factors such as adverse weather conditions, natural disasters, and significant increases in logistics costs. To mitigate these risks, the company has hedged inventory purchases with forward contracts to protect against foreign currency fluctuations. Additionally, committed purchases of green coffee under fixed-price contracts worth $382 million have been made to ensure a stable supply chain. These measures indicate that the company is taking proactive steps to manage potential disruptions and maintain a steady supply chain. However, the underlying concerns about inventory buildup and supply chain disruption remain, highlighting the need for continued vigilance and strategic planning to mitigate these risks. That concludes the financial summary for Starbucks Corporation. Feel free to comment below, and I will be happy to answer them when possible.